I wanted to put a quick video together today to touch on the issue of inheritance taxation, often the forgotten tax in our financial planning. Amongst the expatriate community where I live and indeed back home, most of us are fully aware of how income tax and capital gains tax works on our assets. And that's not just for the UK, whether you're from the US, Australia, wherever it might be, most of us tend to be aware of those things. But the issue of inheritance taxation somewhat gets forgotten about or put back, perhaps because it in itself is a bit of a morbid subject and not something that we like to think about too often. But it would almost be foolish to forget about it. And certainly as somebody who works within the financial planning sector, I can't afford to allow my clients to forget about it. So what is it? Well, ultimately, it is a tax that you are liable for, or your beneficiaries are liable for, upon your death. Now, each state has a different way of doing things. In the US, it's a different system to the UK. In Australia, happy days, there isn't any. But let's just focus on the UK for a minute. So in the UK, if you are a UK domiciled individual, not necessarily resident, domicile and residency are two different things entirely. Please get in touch if you need advice on what the difference is. But if you're a UK domiciled individual, then normally you would be liable to taxation on your worldwide estate upon death, depending upon certain double taxation agreements. If you are a non-UK domiciled individual, then you are likely to only be liable to UK inheritance taxation on your UK-based assets. Again, on condition of certain double taxation agreements. So, what's it look like? How do we potentially mitigate it? Well, essentially, it is if you're a domiciled couple, you are entitled to certain reliefs, so you inherit each other's relief. So, bottom line up front is essentially everything over and above £1 million is likely to be taxable. So, how do we go about potentially avoiding or reducing that tax bill? Right, point number one. Know your worth and know your entitlements or reliefs. Sounds like a really obvious thing to say, but know what the value of your estate is. Tally it all up, add everything in and know what the overall figure might be. Then understand what your reliefs are. So for UK domiciled individuals, everybody is entitled to a £325,000 nil rate ban, and then on condition that you leave your main residence to your direct descendants, in this tax year, £175,000 main residence nil rate band. So if you add those two figures together, you get £500,000. There's no spouse to spouse taxation, assuming you're both UK domiciled individuals, and therefore you inherit each other's nil rate bands too, meaning that as a couple, a run of the mill UK domiciled couple, then you've got £1 million and everything over and above that is going to be taxable at 40%. 40%, it's a lot. A lot of people might say, well, £1 million is a phenomenal amount of money, and it is. But more and more people are getting sucked into this inheritance tax trap, if you like. So if you think about how much house prices have risen over the last 10, 20, 30, 40 years, perhaps you've inherited one or more from elderly relatives, then it's easy to see how you can get sucked into that trap. Be aware, particularly for expatriates, if you are married to somebody who's not domiciled, or you yourself are potentially not domiciled in the UK, then this can add a whole different spin onto things. So again, get in touch if you don't quite know what position you're in. But for the majority of UK domiciled individuals, that's how the taxation is going to work. If you are anywhere near the $1 million or worse, getting anywhere near 2 million, because it gets worse after 2 million, you start to lose that main residence nil rate ban relief, then please just reach out and get in touch and we can potentially give you some advice there. Second point, really, really simple one, use life cover. I meet expatriates every single day and they tell me, I've got my life cover, I'm all sorted on that front, which is great news because it's a really fundamental part of financial planning for most of us. But a lot of the time it's not written in trust. Okay, so if we die, we have life cover in place, it's going to pay out. Where does it pay? It pays into the value of our estate. If it's not already in trust and we go over the million, it's going to become taxable again. So by just using a simple trust deed, which with most insurers is free, you can just download it off their website, get the policy into trust so that it pays out into trust. Free, easy to do. Again, reach out if you need any help doing it. Point 3, understand gifting. There are lots of different kinds of gifts, potentially exempt transfers, chargeable lifetime transfers, gifts with reservation, the list goes on. I guess the bottom line up front is if you give something away, in most cases it's going to remain in your estate for 7 years, i.e. liable to inheritance taxation for 7 years, although that does begin to taper off. Also, you can't just give something away and then expect to still be able to benefit from the asset that you've given away. So the classic one here is your house. You cannot give your house to your children and then expect to be able to just continue to live in it without paying market price rent, right? That's not how the system works. So understand gifting and understand what you've got. You can give £3,000 away each year. You can give £5,000 to your child if they're getting married, £2,500 to a grandchild if they're getting married, or £1,000 to anyone else. And you can give gifts of £250 to as many people as you like. But that's pretty much it. So understand the rest and understand what they might look like. Again, please feel free to get in touch if you want help in doing so. Point 4, use trusts if you need to. This can be really complicated. So definitely get advice in this area. There are all kinds of different trusts around there, around the place. You get one's called Bear or Absolute Trust, and they tend to be reasonably common. And then you get things called discretionary trusts, which look completely different. There are lots of different options out there, and it might be possible for you, depending upon your circumstances, to get money outside of your estate and then still be able to take an income from that trust. Please just reach out, get advice. If you're anywhere near that million or 2 million mark, if you're anywhere near the 2 million mark in particular, just get some advice on it. 5.5, spend money in the right order. Again, seems obvious, but if you understand all of the things that we've just gone through and how the different assets are taxable, then it would sort of make sense, if you have an inheritance tax problem, to spend the assets which are inheritance taxable before you spend the ones that are not. So the common example here is pensions. If your pensions are structured in a way that allow you to delay the income from them, then it might be advantageous to do that. In summary, what we're saying here is essentially understand your position, understand what you're worth, understand your entitlements, understand how gifts work, understand how trusts work and insurance, and then have a clear strategy, just like you would with any other form of financial planning, as to what you're going to spend and when you're going to spend it. By using a combination of all those things, you should be able to bring down your inheritance tax bill at the very least, if not, get rid of it altogether. I hope that was useful. Please take care and stay safe at the moment.